Alrighty, so this is just going to be a quick little scan of the broader market and continued analysis of my thought process going forward the next few weeks and few months and quarter overall. All right, just kind of my thought process, where I think the best opportunities lie, what I think really happens over these next few weeks and months. Like I said, my primary outlook and focus here is on like a quarterly basis. So obviously we had quarter two give us some phenomenal long opportunities on a lot of names, right? On a lot of names. I think the best opportunities were in a lot of mega caps and leveraged index exposure. But there were a few outperformers like this snow chart, for example, right? That you know had a previous kind of accumulation building out on August 5th, right, where we had this, earnings or gap down, the reversion, the low taken out, and the consolidation are all happening off of a report. The lows taken out, very minimal progression, and the character kind of shift into a 30% earnings gap in November of 2024, right? And all this was coming, like I said, off of the all-time lows for your kind of second weekly all-time low, lower low of accumulation. We had the pullback, or we had the draw be into the kind of peg we had above from February of 2024. Obviously, we revisited and attempted to kind of sweep the November gap. And we began to kind of show signs of exhaustion, pull back into the full gap fill, right? There's a lot of intent and relevance behind a 30% earnings gap on the highest volume this chart's ever had. That's very, very important. And then the subsequent pop and consolidation right off the April 4th low up to the high, the ninth, April 7th low up to the high, the ninth, a 27% move, right? A week and a half, 2 weeks of consolidation. And then that path of least resistance kind of establishing itself on this candle right here. But if you look at the hourly print, it's really appealing in terms of a nice pop and consolidation, closing closer to the lows. And then the rally, right, for, even from this April 21st low, right, 67%. You had names like that. You had names also like MU, where I was very confident in this potentially being the shakeout underneath this low. This kind of floor at 85, where you have a 27% liquidation, a lot of selling and capitulating going on, and that buyer, a buyer in general, kind of absorbing that, right? Those hands changing. They get their hands on a ton of inventory in a campaign that's relatively mature. And this shakeout kind of solidifies it, right? This range had already been kind of wiped out of supply. We had the higher low put in within the earnings gap from March, right? If you just look at this kind of path of least resistance that was developed here, right? A test on this, sweep of the May 12th gap, another test, a higher low. We get the breakout to draw to 127, right? A very notable chart, but it's one of those things I kind of like to say. Hindsight's 2020 when it comes to the financial markets, but difficult to time these. This hasn't developed the best structure down here, and you don't really want to hold it unless you have a lot of capital to deploy on this range. You have a 27% week, the week of the 31st. That's a little speculative. You want to wait for that character and that test or last point of support to kind of develop, and we never really got such a clean look, besides within the May 12th gap, but just kind of, quarter two was waiting for that long, right? I didn't make it as much as I should have. I didn't allow that long to really make my month, make my quarter, make my year. But hindsight's 2020. That was a fucking phenomenal opportunity overall. And then you had the opportunity to long it, cover, re-roll in mid-April, especially the week of the 21st, the week of the 14th, kind of being that shorter low volume week, and you had the opportunity. It's a continuation, right, on shares. You don't even need leverage exposure. You leverage ETFs, but shares were kind of the primary vehicle there. But now, like I said, on a quarterly basis, on a month-by-month basis, my focus is 100% short side, minus a few names. Ford is one of these I'll talk about in a little bit. But my focus is 100%, kind of short side driven, just based off where we're at, the way a lot of names look, a lot of individual equities look. at the current moment in time, the way the broader market looks, the timing that this is developed within. I've said before that summer of George is kind of defined by the short weeks, right? We had a short week this week. We had a short week the week of the 16th. We had a short week the week of the 27th. Where else? Obviously, we had a short week the week of the 14th. I'm pretty sure that's it. Yeah. We had Juneteenth, Memorial Day, July 4th, Good Friday, right? We had all these holidays. We have this, 3 or 4 month span going from quarter two, start of quarter two to the beginning, middle of quarter three, where liquidity dries up, right? Where the flows under the hood have more relevance and meaning behind them than they would quarter one or quarter three. Obviously, quarter four, they have a lot of meaning as well in terms of the holidays that occur then and the end of the year flows. But um, but nonetheless, those have a lot of meaning, and especially when it happens after this massive. Well, we had the distribution, we had the breakdown in February to March, we had the lower high developed, we had the secondary lower low that the progression was very weak, and I was actually very very adamant and very very confident that some kind of massive changing of hands would happen, and this would spark the rally potentially to new highs. You can't really predict that it's going to happen like it did in April. That's very speculative. It was very historic. 15% from the April 2nd open to the April 7th, or April 2nd closure to the April 7th open, back-to-back 5% days. Um, it's like the August 5th sequence on steroids, right? We obviously see that kind of the changing of the hands on the 4th, right? Where a lot of that selling at that point is being bid. But we never really see that bottom happen on a Friday. Majority of the time, it doesn't. On a sequence like this, you look back at August, it didn't. You look back at COVID, it didn't as well. And a lot of that is just taking on risk over the weekend, right? I think the larger and more informed party wants to bid this at the beginning of the new week, which is what we see, right? We see that massive, massive intraday move on Monday, the 7th. We see the kind of fake out print on low volume where they're bidding it the entirety of this session on the 8th, and then obviously the continuation on the 9th, the subsequent consolidation, and then the breakout, right? And it all happens into a very heavily skewed May OPEX, where we then see a 3% leg. We continue to bid this kind of floor that we established off the election, and we see the rally higher. Now, what you begin to note within this range is, first of all, we're not really we're barely above all-time highs. From the May highs, right? From May 19th high, we're up 5%, and there's not a lot of volume here, right? This is not really appealing to me. I don't really care too much about like longing this. This was actually a really good long if you look back at the 20th and the 23rd. This is a speculative long on the 23rd of May, right? But this right here was pretty appealing. We had the CPI top on the 11th. We had the breakdown off news on the 13th, where this was a large VIX spike on the 12th, and XLE was getting bid. And that's a big red flag when you have VIX up 4%, equities green as well, closing near the highs, and energy as well, seeing that really nice follow through off of a higher low that was put in early May, or late May, early June, right? And so we have this kind of fake out print. We have this gap down, this lower high that we develop on Monday, the bidding of the NWOG, the breakdown of that, and then that June 20th print. My primary focus on that day was a squeeze in the day on OPEX. We didn't get that, right? We got the kind of two lows of accumulation, the relatively, flat close, the breakout on Monday, the breakdown, right? And the way that this happens off of news, establishing that third lower low of accumulation with a lot of volume behind this Monday, June 23rd print off news, and then the subsequent consolidation developed after we get the rally, right? We get the continuation. This was pretty appealing long, right? This was a pretty appealing long on shorter dated opportunities. Nothing to open up a large position. Just targeting these gaps above here at 603, right? But we obviously see higher than that. We obviously see the gap up on the 24th. All this kind of leading into the quarterly expiration as well, right? You have to pay attention as to that being very pivotal the quarterly expiration. And like I said, it all means so much more coming off of this general sequence, right? There's a lot of positioning that's in the money, a lot of delta that's being hedged by dealers as these go further in the money. Just a lot of sequence overall, a large important sequence overall, right? The indexes have so much importance and relevance behind how the broader market moves, how unpinned or pinned it can be. And then the options and derivatives market as well has a lot of meaning and relevance behind the movement going on in there, specifically the market makers warehousing the inventory, um, of these derivatives and having to hedge as the market moves via selling and buying the underlying. But this, this is not appealing, right? We see the higher low put in, we see the micro higher low, internal higher low put in the 20th and the 23rd, and then this rally, right? And this is, backed on very little, very minimal volume, very minimal effort versus result. We see a 5% result from the May highs with very little effort put in, right? Obviously, it's a short week this week, so you're not expecting that much volume, but you don't want to see a breakout like this on a week like this with such a little amount of volume behind it. With such a clear, notable sign of exhaustion, the spread's getting relatively smaller, the volume dying down as we trade higher, or the spread's either getting smaller or larger as the volume dies down, or if it starts to ramp up. This is kind of just signifying a lot of the late buyers being trapped, a lot of the demand being absorbed, a lot of that buying being sold off to. Because remember, right, for someone to buy, someone has to sell and vice versa. A lot of the informed party, offloading their inventory to those breakout boltards, retards, we could say. And, changing of the hands, right? And considering that this is all happening above February highs, which are, 2-3% lower, right? This is not really the most aggressive signal of a healthy breakout at all-time highs with these gaps left unfilled below, entering a window where there could be a little less of an effect from these Vanacharm and structural flows, and a lot of names align with that, specifically Mag 7, which has a lot of weight in these indexes, right? So that's kind of my S&P 500 outlook. We have earnings season coming up in a couple of weeks. We have Vanacharm flows returning for July. Vanacharm flows coming for July next week, but I don't think that holds so much relevance. We have Vixpiration the 16th and OPEX on the 18th. I think that's going to be that window post that we can get a short, especially I think the way that this is developing, especially if we get another subsequent gap up tomorrow, or not tomorrow, Monday, we can get a really aggressive reversion to 600, maybe just to these highs, and develop like in the last point of supplies, post-July OPEX and Vixpiration, and we can trade down to 600 to 579 and then 564 probably into August. It's kind of my outlook, right? I think August, September, maybe October, we were going to revisit 564 to 555. I think that the best positioning right now. I think that first of all, this range has opened up so many clear signs on where I think the best trades are, and I don't think it's on a day-by-day perspective. I don't even think it's on a week-by-week perspective the majority of the time. I think it's on a monthly or quarterly basis, right? I think building up that long in April, early and mid-April, capitalizing, and now in June to July, kind of building out these shorts on 2026 expiration, or even just on leveraged ETFs is phenomenal. I think that you're seeing a lot of red flags as far as rotations, as far as risk off names, seeing a lot of bids be established, and a lot of laggers kind of show their hand as well, right? We look at QQQ, this is a very low volume, low effort breakout, right? Happening after that influx of volume off of July 27th, kind of putting in a lot of volume on the last day of the quarter before the expiration, right? I'm not a fan of this. I'm not a fan of the price action that followed it, or that preceded it. As far as like quarter 4 of last year and quarter 1 of this year, really giving you these exhaustive highs, the breakdown and the rally. Like I said, just with all these gaps left below, it kind of gives you, similar to how we had that long reversion, a reversion to the mean as well, right? Not a very appealing look. Higher time frame distribution that I think is kind of developing and has really been developing. The election kind of potentially being our buy climax. We see that reaction to 18th. We see that sign of weakness. We see the UT. We see a potential UTAD being put in here. And my broader market outlook is still bearish for 2026 as well. But nothing healthy about this. I think we revert into these gaps below this quarter. I think you look at XLF, right? This is one of those things. These things take time to develop, right? A top is a process. We see it take weeks to happen. It takes weeks to happen in December to January to February, right? Leaving these gaps unfilled, exhausting these bids internally, stalling in exhaustion at the highs, the windows opening up. It takes a while. It takes a while for these things to happen, right? And we see XLF as well developing the potential third higher high of a distribution, right? And you want to take into consideration as well progress, price covered over time, right? It's taken us 120 trading session or 120 days to make a 1% new high at this point within the chart on XLF. It's not a good look. And all of this is happening from the kind of preliminary supplies of a distribution within Q1 and Q2 of last year. We see the climax off the election. We see the reaction. We see the distribution on a daily scale happen above these highs that we established in November after we didn't fully fill the election gap, where there was that kind of climax, in my opinion. And then we see the breakdown, lower high, and then the massive kind of change of hands that sparked this rally that I don't think is very structurally sound, leaving these continuous gaps below, and a lot of equity within this sector looking very gross as well, right? We look at JPM, these kind of exhaustive breakaway gaps on low volume as well, right? We look at Schwab. This is a distribution within a distribution within a distribution. I've talked about this so much. If I had to take a big hit, one big trade into 2027 or 8, bro, Schwab exposure to $50. Shit. I don't know, but it's just nothing super clear yet, right? But big red flags. When you look at XLF, you look at QQQ, look at XLK, you look at these names that usually give you the red flags before they happen. And XLP, right? We look at XLE. We haven't reverted to these gaps above, right? You know, contrary to how SPY looks, the S&P, the SPX looks, we haven't reverted to these full gaps. This has been relatively underperforming, and now we're kind of seeing that, right? We see the higher low put in late May, early June. We see the rally. We see this kind of capitulation print. This is where energy gets a little bit interesting to me, right? This massive, massive breakdown on the 23rd. I think a lot of late bids were being trapped up here trying to chase the longs after, we saw a pretty nice move on this sector. And then we see the breakdown into some kind of selling exhaustion, some lower volume developing, seeing a nice follow through on this Tuesday and Wednesday print. So if there's a sector that I think could push a little bit higher, it's definitely energy. You look at like a ZOM, has that full April 3rd gap to fill as well. We see an attempted higher low being put in with some follow through as well on Tuesday and Wednesday and Thursday. Obviously, we have to get through this massive, massive kind of imbalanced candle. But pulling back and filling these gaps below, basing relatively important spots with reversion to the mean still kind of being a potential play here on this sector. As far as to the remaining gaps above, I don't mind it, right? Especially with all the subsequent consolidation that we develop following this kind of range. Like we sit inside this print until for a month, right? We sit inside this April 9th print on XLE for a month, whereas SPY is already 10-15% off the lows there, probably more. So definitely a sector I think could have a little bit more room. I don't know if we're going to kind of revisit new highs. That would be a little speculative. I would more or less focus on the 90 to 94 range, kind of higher highs, higher low structure continuing to develop on a commons position. Maybe on like the ERX position, you could definitely get a decent little move. Like from here, you could definitely get a 12 to 24% move on commons on leveraged exposure energy without having to worry about time and volatility. But like the CVX chart, this doesn't look terrible. When this sell-off kind of results in this exhaustion, If we can just push through this massive, massive breakdown, I think we can revisit some gaps above. Oxy's not my favorite. Uh, VLO was a fucking beautiful one. This is what I will say, right? This is a beautiful one. These are some names that have been relatively underperforming, right? In terms of, you look at Zom, we saw some decent legs in quarter four and quarter one. We saw some decent legs in the September and the October range, even like CVX and Oxy as well, where we saw a couple decent legs. These haven't really been giving you much, like VLO and MPC. We've kind of just been breaking down, continuing to develop these climaxes here and here in December off the Fed meeting, and then here, and then we get the consolidation, we get the gap up on the 12th, and now we're kind of seeing this April 3rd closure defended, right? We're seeing the bidding occur here. We're seeing the breakout. We're seeing a really, really nice move, a 15% move, a higher low put in, and a really, really strong, healthy follow through on this sector. I like this chart. I mean, obviously you're a little late now. That 126 spot was kind of key. You have about $4 to $5 of an entry there for about 10 to 15 for a reward. Trading it into the kind of these equal highs up here. But a really, really clean chart there on the VLO and on MPC as well. VLO kind of being the more appealing one to me, but a very, very clean chart here. Very easy move on commons on a very notable sector that, I mean, this is an outperformer within the sector. And there's kind of a lot of meaning as to why this is an outperformer right now, right? This is 47% off the lows. This is only about 20 at the highs of this range, right? So there's the underperformers, there's the overperformers, right? You have to obviously choose within a sector what you think is going to outperform the underperform if you're longing that sector, or you just take XLE and get the best of both worlds, which I think is kind of the move here at this point. Obviously, back in late May, early June, VLO was a more appealing name than like a Zom, which was kind of pulling back a little bit deeper than discount into this April 11th print. CVX kind of not really giving you the cleanest structure. Here, as far as a strong bid and a nice and constructive follow through goes. Oxy kind of a similar thing as well. So VLO is obviously the best long. Within this range on energy, right? I think it's a little bit speculative beforehand. I think this is kind of the opportunity that lies, the best opportunity within this late May, early June sequence, but nonetheless, a pretty good move, right? Estimates a very similar sector to financials, right? Where we have the preliminary supply dating back to quarter one of last year. We have the kind of potential UTs developing, climaxes developing in quarter two and quarter three. See the reversion trade, see this kind of consolidation within this range, breakdown, reversal, and now I don't like the structure behind this chart. I don't like the structure behind a lot of semiconductors. I think a lot of them had the couple that I did like have kind of made their moves as far as the Lamb researches and the um and the sorry, and just the lack of appealing structure. Like I said, with the gaps to fill below, we're filling these gaps above, we're fading these new highs. It's been a year since we put in these highs, and this breakout is already kind of giving you clear signs of exhaustion and trapping of the late long. So that'll be a focus, kind of that sector in general. Talk about a couple of those names. ARKK. Not really much to say about this besides the fact that this definitely could still outperform. There's definitely like a broader, higher time frame accumulation dating back to 2021 to early 2022 here, to early 2023. But not really a daily chart that I like too much, especially with Tesla not giving us the best daily look anymore right now, personally. Now, there is a couple of rotations that I'm potentially seeing, which, I don't know, a little speculative, right? But like I said, with that dispersion, you know, if indexes are pinned, what we've been seeing lately, if indexes are pinned, right? If indexes are pinned, the S&P 500 index is pinned, right? Where there's 500 stocks. If that's pinned, some things are going to go up, some things are going to go down, right? You're going to have these things that outperform. You're going to have these things that underperform. It's usually going to be sector by sector. This sector outperforms, this sector underperforms. That's what kind of creates that dispersion aspect and that pinning of the indexes. However, what happens when those outperformers at new highs start to stall, and those underperformers and those laggers start to see the money that's been being rotated into them get a little bit more aggressive? Well, naturally, we'll have a rotation at hand. And I think that's potentially what we're seeing here, right? We have a really, really nice print on IWM put in on Tuesday. The July 1st print across the broader market is very, very important to me here, right? Because you look at XLK, right? You look at this, 0.9% day. You look at QQQ, 0.9% day. You look at XLP, 1.25% day. You look at IWM, 1.03% day. You look at XLV, 1.42% day. This is something that people don't pay attention to as much as they should. And that's the rotation and the out and the risk off and risk on names, right? We have a clear rotation at hand here. When a lot of the Mag 7 names look fucking disgusting, a lot of the tech leaders, Hood, Palantir, Nvidia, Meta, Microsoft, that are at new all-time highs. I had previously talked about the breadth currently going on here. The lack of new all-time highs on these S&P 500 stocks is very appalling. There's been things that have been holding this market up. Financials are at new highs and they don't look that good. Tech names are at new highs, and you're kind of seeing this exhaustion pan out on a lot of these names. And then you see XLP, which hasn't, XLE as well, which hasn't. You look at that July 1st print on XLE, really nice green to red 0.7% session. XLP, a notable, I've talked about this, a notable underperforming sector in comparison to the broader market, which is always going to happen. But we're seeing that consolidation, right? And we're seeing it all happen. Here's that May 12th print, right? Indexes were up 3% May 12th, S&P 500 index. These consumers were getting bid lower. We see the exhaustion. We see a really nice rally from 79 to 83. We're seeing this now be digested. Super clean follow through 2-day inside bar pattern. You look at a lot of individual equity within this sector as well, right? We go ahead and we look at PEP. You don't even have to long these. These are very slow movers and not really common trades that I'm very fond of. But you look at PEP, right? You look at the climaxes being built out off 2021 lows, happening off of this capitulation off the report, or potentially capitulation. All this low being bid, this one being bid, the subsequent lack of progression, and a really clean rally from 128 to 135 off the lows, 6% within like a week of trading. There's a clear, underperforming sector underneath these April lows that's getting bid, right? And they're bidding it and front running the preparation of these rotation and risk off names. You look at MO, right? Here's that May 12th open, down 4% on MO, right? You look at, Palantir, May 12th. Okay, bad example. Snow, May 12th. 3% session, right? That was a very important day for rotations, in my opinion, personally. And that's something that I think a lot of people don't pay as much attention to as they should. And I think that July 1st print is very, very pivotal here, because you look at Nvidia's July 1st 3% session, and then you look at XLP 1.25 on such a low beta, low moving, low volatile sector. That's big. That's a good signal. The first day of quarter 3, we're seeing that happen. That's a very, very big signal there. That's going to probably be very telling of what's to come in terms of what underperforms and what outperforms as we lean into a market that's going to have a little bit more volatility potentially. I wouldn't expect this breakdown to be like a very aggressive vol event. I'm more or less kind of talking about the fact that why does it say this is up 6%? More or less thinking about the fact that we're leading into something that could potentially lead to the unpinning of this. Maybe not. Maybe you just continue to see, you're always going to see, rotations and whatnot. But I'm thinking in terms of my broader context on Nvidia is still very bearish, but I think PEP trades higher this year. Things like that. Like, you're going to be we're going to be entering a market where there's a very clear rotation that's been going on, and we're going to see the ramifications and continuation of that rotation out of these names at highs and of these names at lows. And it always happens like that. And there's usually a time frame that it always happens, and it's usually around this window and around quarter one. So that's something that I feel like you really, really, really have to pay attention to. You really, really, really have to pay attention to that. I've talked about this in video chart. I think this is a phenomenal short this year. I think this is a higher time frame distribution since March 8th. I don't think that these two lows, April and August, outweigh the cause that we've built out in March and June and November and January and now in May and July or June, right? Where we see the reversion trade. We see the breakaway gaps in early May. We see the preliminary signs in mid-May, right? We see the earnings report result in a really nice gap up, a 7.5% move after. And then this low, and we're all this is happening while we're leaving all these gaps unfilled below to be the draw later. And then we see the kind of very, very weak float, right? The high low that we put in on the 23rd, the rally where the volume and the spreads get really wide, and this exhaustion kind of signaling, like I said, that absorption of demand and that changing of the hands. Breakdown on the 1st, and then we get the continuation on very little buying effort to end off the short holiday week. But it's one of those things. I mean, when you see NVIDIA look like this, when you see, Meta look like this at new highs, leaving these gaps unfilled below with very aggressive and notable legs coming off of this, Microsoft as well. When you see all these developing with these breakaway gaps left unfilled below, that's going to be the eventual draw, in my opinion. And like I said with the rotations, it's very, very clear, when you're seeing XLP look like this, XLV look like this on sectors that haven't been performing like XLK. When I think about that dispersion, I'm thinking about things go up and down, and I think about, okay, if that dispersion's happening, you have an outperformance in tech, underperformance in consumers and energy, for example. What's going to happen when the roles flip, right? When the money's out of tech and those see the subsequent effects of the cause built out, and vice versa for the causes and accumulations built out on these bottom feeders where the larger and informed party is front running what's going to be an eventual rotation in those risk off names, in my opinion. So I don't like this NVIDIA chart. I still think we revisit the low $100 range this year, and I'm still confident in that positioning. Tesla, decent weekly print holding the June 6th closer. I don't mind this. I don't like to see this consolidation and compression underneath the bear gap, an 8% day with a 10% intraday move, and then the failed breakout kind of develop the gap down off delivery numbers, gap down into delivery numbers where the progression is relatively weak. Obviously, it's a low volume, short week, so you have to take that a little bit with a grain of salt. I still think this can trade higher. I think that the three Mag 7 names, NVIDIA, Meta, and Microsoft, are very gross. But I think Apple trades a little bit higher. I think Google could, and Amazon could, and so could Tesla. I want to talk about this Apple chart though, right? This is another higher time frame distribution, in my opinion, throughout this entire past year of price action. And we see the last point of supply developed following the exhaustive UTAD into the end of 2024. Lower high of the report, take out those highs. We see the breakdown, and then we see this compression, right? We see about 7 or 8 weeks trading inside this print. We see this May 2024 earnings gap be filled, gap up the 14th, where we see a very large seller. And then we see a lot of compression within this name. We see the breakdown, we see the draw into the gap, breakdown off the report, fill these gaps, another pop off the May 12th gap, breakdown in these bear gaps, gap up, kind of exhaustion, kind of get this higher low established, put this nice print in on OPEX. This is a lot of consolidation and a lot of liquidity for now. First of all, built up at this 214-13 range, but also just you can signal and see the lack of aggressiveness behind this seller and where the clear-cut draw is going to be, right? It's going to be that full gap fill. It's going to be that full gap fill that is also happens to be at 618. We have this full gap to fill on a 10% day on the third, which is very important and a very notable outperformer, or underperformer, I guess you could say, of that breakdown on April 3rd, right? So a lot of compression, now kind of finally breaking out of that range on a 6% week. Not really such an appealing long for me, more or less a name that I'm not very concerned if this pulls back into that 224 range. There's a lot of meaning behind that, and I think that's where the draw is going to eventually be. Talked about Meta and Microsoft. You see that kind of May or June 16th gap, high or low put in, rally to an exhaustion at new highs on Monday. Google is one that the progression is kind of stalling if you look at these new highs being put in. So that's a kind of red flag in my opinion. Don't really know what to expect. The report could get you a move up to this gap that we have unfilled from January or February. So pay attention to that. And Amazon as well, that kind of still have these full pegs to draw into. They're not really giving you the clearest signs just yet, but still have some gaps to pull back into that I think could kind of eventually be the draw on these names. But no real reason for me to be long exposed much, especially not on leverage. I think Tesla could pull a little bit higher. I think Google could as well. That'd probably be it for me. So now leaning into individual names, I talked about Pep. Ford was a really, really nice long here, right? I think I talked about this in the other video, but I think it was before. I think it might have been on Tuesday, but look at this: 5% day, a 4% day, all happening on a name that developed this second low of accumulation in August, saw the breakout to this 1137 range, the stall within this point within this chart, and then we see this kind of draw be lower, right? We start to take out these lows on the report in February with a lot of volume back behind it. And all of this happening after a 12%, 18% earnings gap in July is pretty important as well. And then we see the kind of weaker leg, the massive breakdown, and that notable amount of volume pouring in here on the 7th. A nice pop, nice higher low, rally, constructive higher low that we develop off $11 here. Very, very, I mean, you can just look at this chart and see how clean it is. You see how clean it develops this leg off these lows being taken out. Beauty of a shares trade off that. 1 second. Just, beautiful lows taken out and very, very nice hammer candle on this April 7th print. The highest volume you see on this name in a little over a decade. Starbucks is a really clean one as well. Like I said, a notable kind of underperformer following April 7th's lows. Filling this very historic August 2024 gap that we had. And then double bottoming off that kind of a very weak low off the report with even more volume. Higher high, higher low, another subsequent higher low. And then we see this nice rally into the April 3rd gap. Like I said, that underperformance of some of these names is very notable with these gaps being left unfilled. Pop, a lot of consolidation. Some news hit on the 27th, and then that path of least resistance bar breakout and higher low, right? What I mean by that is we get the really clean pop, the drawback into this range. We see that news wick on the 27th put in the breakout. The breakout off Monday's open, and then we pull back and we revert a little bit deeper than you would think. But with the volume back behind this kind of news print, with the relevance behind this, there's going to be a lot of kind of imbalance behind that range. We're going to pull back into it, and that's exactly what we do. We don't really see a lot of signs of a larger seller, more or less bidding at new lows of day on Starbucks. And so that's what I kind of mean by that path of least resistance print, where it's a really nice pop, a lower volume sell, pulling into an important range, and consolidating, and that's why we get the really clean pop. And this is our change of character. This is our subsequent secondary high or low, reclaiming the gap. And now you get that kind of path of least resistance, breakout, high or low, 2-day inside bar pattern to end the week off. A name that you can really bid some commons from about 91 to 99 pretty easy, or you can take some further dated expiration options, which I think would be a little speculative at this point within the broader market. But on this little 2-day inside bar pattern, a couple weeks out might play here to 95. If you do take that opportunity, risking that kind of progression gap off the April 3rd open. Nike, I talked about this as well. We saw some continuation this week. I think we saw some news hit on Wednesday that sparked a bid. But one of those names that I don't really, the long off 60 is speculative. The maturity of this campaign being built out is not anything I wanted to question. But I never really saw a very clean change in character or a very clean pop until now, right? We see a 15% gap off the report, a little bit of continuation. I think that steam is potentially kind of exhausting. I think it's running out of steam. I think that if we can see $80, this can maybe align with a broader market sell and pull back to 69, then we can get a really good long entry on some commons or further dateds. But a really appealing chart ever since last July report that brought us down 20-something percent. I'm really confident this name pulls up to the 94 to 100 spot. Now we're finally seeing that structure shift and potentially an opportunity to long some commons on this from like 70 to 90 to 100. But another kind of underperformer, potentially seeing some continuation. Right? Not really such an underperformer in the terms that we did rally 20% off the lows. But a name that's been getting beaten up for the past year while indexes, make new all-time highs. And then probably the last chart I'll discuss is this First Solar chart, right? Another beautiful commons trade off the 130 to 140 range. A speculative sector that moves relatively aggressively, so that's something that you have to take into consideration. But I'm really focused on this general range right here, right? We had this really clean pop in May of 2024, a stall within this kind of previous distribution from 2008. Like I said, this is a speculative, volatile sector, right? So you want to kind of take it easy on this. But what I noticed is we continue to build out these climaxes all throughout, August 5th, the election, the report here. And we finally see a really nice leg on the 12th, right? We finally, this is the highest volume we've put in a while on this name. We finally see a really nice leg and some really clean consolidation and digestion after. All this kind of happening off of the taking out of the 2023 lows. The climax is built out here. The earnings report being a catalyst. Really, really clean move. Consolidation. And we see the potential June 3rd print being the low. Rallies, fills the gap, right, which we still have those bear gaps above, about an 8% day on the 19th. And then we see the breakdown off of some news on the 17th. But now this is a 40 million volume candle filling this full gap, establishing a really, really clean higher low to be put in on a weekly perspective, filling the in-walk, right? This is a great opportunity. I mean, you can get a good average from like 150, like you can get a 140 average, and you can ride this to 195 to 200. This is a really clean chart. We're now seeing a really, really nice pop on it. Good shares trade, I'd say, about 30 to 40%. De-risk that, potentially take it a little higher on this kind of accumulation building out, potential higher low being put in. But that's pretty much it. I mean, that's kind of my outlook for continuation in the next week and month of July. I think we do get the short. I think the short comes, and I think it's going to come aggressively the way that this builds out. The broader context is still bearish. The more that this develops into an all-time high UTAD, the more confident I am. And the way that this is developing gives me a lot of confidence in the short-sided trade. And nothing has really changed since early June, even late May. It's just timing, right? This is a low volatile window, holiday weeks. Timing is pivotal here, and it takes a lot of time for these things to develop. and that's something that I didn't necessarily predict. My positioning was not anticipating that. I think the positioning that anticipates and waits to get really aggressive or buys a lot of time or just buys leverage ETF or inverse ETFs is the move here. But um, you're seeing a clear rotation out of the leaders that hold a lot of weight in these indexes, right? Being the Nvidias, the Metas, the Microsofts. I'd like to see Apple at 224. I'd like to see Google and Amazon in those pegs. I'd like to see Tesla pull a little bit higher potentially, but when you see a lot of those names looking very gross, when you see a lot of names like Pepsi, Starbucks, Nike, all these names looking a little bit appealing, you have a clear kind of rotation out of the leaders into the laggers that have been underperforming during this kind of rotation, not rotation phase, but this kind of dispersion, you could say, right? But yeah, I'm still very bearish. I'm very bearish for this quarter. I'm very bearish for next year. I would love to see 550s, a last point supply put in a February, or like January or February, and then we see 440s by next quarter four, personally. So that's pretty much it for me. I mean, that's my broader market outlook continuing to be bearish, and my reasoning why and why I think so. There could also be some things under the hood. Like there could be a broader market crash based on the housing market, based on the debt, based on some credit. I don't know. I'm looking at the charts and paying attention to the charts and the sentiment in the context of where we're at and when this happens. And that's my thesis here. And a lot of the leaders, especially 2020 to 2022, 2020 to 2025 being a very aggressive rally, 2022 to 2025 being an aggressive rally. I think a lot of money has been being rotated out of these names from the 20. Like look at Nvidia, we're up 1,300% from 2022 lows. That's not normal. So I think there could be a broader context bearish sentiment for the next couple of years to come that people aren't ready for. Off 2022 lows to now is one thing, but off 2025 is another thing, and a lot of these names have been seeing higher time frame rotations, in my opinion. So be warned, right? Your long term positioning here, be warned personally.